Hey everybody, welcome to Buckhorn Drive. My name is Bryce Elder with Sunrise Mortgage Group, and I'm here with Andrew just to show you some options about how to finance this thing. I love using this tool. It's called Mortgage Coach. It's probably the best mortgage calculator I've ever found in the 20 years of doing this business. I think it's great because it allows us to see multiple different scenarios side by side and be able to find out what the trade-offs of using different loan types, different loan amounts, different interest rates, the whole spectrum of different ways that you can structure a mortgage. It helps us to be able to determine whether those monthly payment differences are looking good or not, how those are going to affect us. It also helps us to see what those decisions will cost us over the midpoint of time. So, 78% of people are either going to sell or refinance their loans within the next 5 years. Now, that number is constantly shifting depending on what interest rates are doing, but it sure is cool to see what that looks like. We can use that strategically to determine, what the risks are that we, put a loan together one way or another. And then down here on the bottom, you can see what that looks like over the long term. Right now, I've got this set to 15 years, but we can switch that up. So Mortgage Coach is a great way for my clients and I to remain literally and figuratively on the same page when it comes to different mortgage strategies. So what I've put in here for now is just a range of different options when it comes to down payments. On the left-hand side, I've got a 30-year fixed FHA, 3.5% down. That's one of your minimum down payment scenarios. It's your quintessential first-time home buyer scenario. FHA has some other flexibilities if your credit is challenged, or if you don't have a lot of assets, or if your income history is a little bit spotty. That can be a great solution. The next scenario I have in here is a conventional 5% down. That's great if you want to preserve money or your capital from your down payment for other reasons, like sometimes when you move into a place, you want to do some renovations or something, you want to make it yours, you can do that. But anytime you're putting less than 20% down, you're going to pay mortgage insurance in some way, shape, or form. Mortgage insurance doesn't protect you, doesn't protect the house. It protects the lender in the event that you were to foreclose on a loan. So we're going to show what the differences look like on that versus a 10% down payment and then also a 20% down payment where you don't have to make that mortgage insurance payment. So top to bottom, Mortgage Coach shows us here's our purchase price, here's our loan amount, here's our interest rate. This is the note rate. This is the rate at which you would repay. Right underneath that is APR. People are always asking me, what is APR? APR is an expression of your interest rate plus the total cost of the loan re-expressed as an interest rate so that you can compare the cost of the loan one to another. But it is not the rate at which you would repay. So let's be clear, your note rate is the highlighted one. Underneath that, we have 360 equal payments as a 30-year fixed. We can also do ARMs. We can, I'm not a big fan of them. I've been doing this business for 20 years and I've seen what that's done to some people. What we really want to do is make sure that your expectations are set for the future correctly. We can talk about different types of loans outside of this. Right underneath there, we have your total monthly payment. Notice this is double starred, and if you go down to the bottom here, you can see, okay, this includes your property taxes, homeowners insurance, mortgage insurance, and HOA dues. In this case, we do have some HOA dues, so we want to make sure we're taking those into account when we're doing our budgeting. If we want to see the component parts of that monthly payment, really easy to do. We're just going to pop into this More Info tab right up here at the top. That's going to be your best friend in the world. Use it early and often. And when you do, it'll bring you into these three sub-tabs, two of which we're going to probably use a lot in our initial consultations. And then when I check up with you, in 2 to 3 or 4 or 5 years, and you've maybe making more money, and you're thinking, what do you want to do with the extra money that you're making? Should I pay down the mortgage more aggressively, or should I be putting that in the stock market? Then we'll use the reinvestment tab, which we can use to calculate your net worth over time, which is awesome. But for now, let's take a look at the payment breakdown. So in this scenario, we have your principal and interest, we have your property taxes, we have your hazard insurance or your homeowner's insurance. You're going to be able to shop for that outside of what we do here. So make sure you're connected with that. If you don't know a good insurance agent, we'll have good recommendations for you. And here's that pesky mortgage insurance. There's what we're talking about. So notice we start to really be able to see here the trade-offs of being able to bring us a lower down payment. And it's what they say in mortgage and real estate is true. If it sounds too good to be true, it probably is, and there's usually a trade-off. So for the privilege of being able to put a lower down payment on there, you're going to have a higher mortgage insurance payment. So you can see how that sort of rolls off as we get closer to that 20% down payment. So if we were looking at just that, here's what your total monthly payment would be. But remember, we do have some homeowners association dues in here, and that's where we're going to pop those in. If you're looking at different properties, we can absolutely swap out different properties in here, and that's kind of one of the fun things that Mortgage Coach can do is if you're looking at a range of different properties and you already know your down payment, we can really compare the costs of each of those properties over time, which is really neat. We can also go in here and check out the closing costs section. In this case, we're going to make it very clear exactly what your down payment is on each of these. And then I don't super love what Mortgage Coach does here, but they subtotal each different section of your costs into these subtotals. So APR costs, your non-APR costs, your points, and your upfront mortgage insurance premium, which only FHA has, not the conventional ones, and then your prepaids. Now, when people look at this, they're like, what is an APR cost? That doesn't tell me anything. But part of the consultation that I'll do with you is we're going to take you in and we're going to train you how to use Mortgage Coach. We're going to bring your eyeballs down to this fee detail button right here. We're going to click on that. And that is going to do exactly what it says it's going to do, which is to give us more detail on any of this. And you and I are going to go through this line by line by line, and we're going to tell you what each one of these fees is. Who gets paid what and why? Are any of these negotiable? Are any of these things able to be paid by any other entity around? In some cases, if you're doing a 20% down, there might not even be an appraisal. So maybe we have an appraisal waiver and we help you to be more competitive than someone else who's vying for the same property. But we're going to explain to you what each and every one of these things is. And I think when you understand who's getting paid what and what job they're doing for that, then you can start to say, it's not just a bunch of fees in here that Bryce wanted to charge me. No, if it were up to me, there would be no fees. But there's a lot of people that have to do a lot of things. A lot of people have to touch this loan in order to make it happen. And I'm going to tell you about what that looks and feels like behind the scenes. And then you'll really have a good understanding for why it is that you would need to bring this amount of money to the closing table for your closing costs. So you take that number and you put it on top of this number, and that gives you your total cash to close numbers, which will show up here on the front of Mortgage Coach. So that's your cash to close. So point being, if you're comfortable with this number and you're comfortable with this number, then fire at will. You are ready to go. And part of what I'm here to do is make sure that you qualify for that. We're going to do a loan application. We'll do an initial consultation first so that you can sort of see behind the black box. How does this all work? We'll talk through it before you put any numbers on paper or before you do any loan applications so that you'll have a decent idea of what it looks like for you and you can decide whether you want to move forward based on that. But I think that this is a way of communicating around mortgages that is pretty rare in this industry. I think only about 10% of people who are in this industry use and wield Mortgage Coach in this fashion with their clients. And it's just unbelievable. The way that we can break it down is super cool. For instance, hey, we know that the difference between doing an FHA loan and a conventional loan is that FHA has upfront mortgage insurance as well as monthly mortgage insurance. And therefore, even though it has a lower interest rate associated with it, it has a higher cost over time because that mortgage insurance never goes away, right? It goes down a little bit year over year over year, but it never goes away. Whereas with a conventional loan, we can go into the payment stream here and we can see that if you weren't to touch anything at all, the payment would actually go down because eventually you're going to get rid of that mortgage insurance simply by the process of amortization and paying it down. There are going to be ways with a conventional loan that you would be able to get out of that mortgage insurance maybe a little bit sooner, especially if you're going to put a little bit of sweat equity into the property and are willing to get it reappraised. But we can see very clearly that over time, if you can bring just another 1.5% down, over the next 5 years, you would have saved yourself almost $10,000 by making that decision. So how does that break down? Well, let's take a look in the View Details section. When we bring that up, we're going to see over the next 5 years, how would the numbers have shaken out if I had made any of these decisions? we're going to see very clearly that it's going to give us an accounting for this. So here's your total principal and interest payments. Obviously, that'd be less if you put more down. How much principal will you have paid over that amount of time? What will your balance remaining look like over that period of time? How much interest and mortgage insurance will you have paid over that time? And then, did you pay any more in closing cost or points for one scenario versus another? It's going to take all of these things into account, and it's going to net you the savings and show you exactly what that looks like. This is important, you guys, because 78% of first-time homebuyers or homebuyers in general are either going to sell or refinance their loan within the first 5 years of home ownership. And so if we're being predictive about what your life story looks like and we're being consultative about that, we're giving you good advice about how to treat that, then this is a tool that we want to use. And then, of course, over the long haul, we can see what paying less interest looks like over time, and mortgage insurance too. So anyway, I hope that you find this a useful tool. And if you do, please hit the QR code that is going to be somewhere here on the property, or you can come talk to me. I should be around and would love to talk your ear off about it. Obviously, I get overexcited about these things, and I geek out about it. And I think everybody should have access to a tool like this because it eliminates analysis paralysis and helps people make confident decisions in home buying. I hope I can help you do that soon. We'll talk then.